Good day, everybody. Some really interesting moves recently. It's been a couple of weeks since we've touched base. Let's have a look at what equity markets are doing. They're moving. It has to be said, there's some elevated volatility to some degree, not as much as we're seeing in FX and bond markets, but still we're seeing some moves in equity markets. Since the CPI release, that was slightly less than expected, stocks have done relatively well, but there's swings, there's lows, there's highs. So what's going on? Fed speakers have started to comment on smaller hikes, which is relatively hawkish or bullish for equities. Are we reaching peak inflation? Are we reaching peak dollar? These are questions that are definitely up there. The FOMC still raised 75 basis points, though, at the last meeting, and Powell was hawkish, so that was actually negative for stocks. So you can see the sways that are in here. Then we had the unemployment rate, which ticked up very slightly higher, but the data was generally relatively weaker than some people expected. So we saw equities rally on the basis that they felt that the Fed may not have to go as hard against inflation with weakening unemployment, which is what they want to see. So up small. And then we saw the up big. The US CPI data for October was well below expectations. And we saw a very significant rise in equity markets. Obviously, from all that, it shows that the CPI data, the inflation data out of the US is the big key here still. But we have seen some hawkish Fed speakers continuing to sort of counteract that with sort of comments that maybe there's a lot more to be done. This is not the end. We're nowhere near a pause. But also we've seen increased China COVID cases, which is counteracting some of that. So back down again on that sort of headline. So you can see the choppiness. So we've got you can see on the chart here the deceleration of US inflation on the left here. It's beginning to turn over. Is it trending lower? We don't know yet. So that's an unknown as well, which adds to the volatility. There's no clear signal there for us. On the right here, we've got where the S&P was on the 13th of October, 1st November, and the 21st of November. You can see the move higher as that CPI data filtered in. We've done pretty well. Look at the USA 500. This is a 4-hour chart on the bottom. Overall, we've done very, very well since that CPI data came in. We spiked higher. We've consolidated. We're holding. What next? And I think that's the key now with the FOMC minutes tonight, Thanksgiving tomorrow, an awful lot of uncertainty ahead with poor liquidity. But remember, we're just starting what we call the silly season, the holiday season in the US and around the world as we move towards Christmas and year end. A lot to be thinking of as we move into that. So the known events that we know, the known knowns, if you like, as has been said by a very famous US central banker, it is clear to see the impact of US inflation has on stocks. I mean, it's very clear. Inflation comes off, stocks want to rally. And because the Fed may be deemed to be doing less or being less aggressive going forward. So what are the known events now for traders to put in their diaries to focus on? We need to look at what's going on. Now, first of all, tonight, we have the Fed minutes. The FOMC minutes are tonight at 7 o'clock. Not long to go now for those. Where are the Fed on slowing of hikes? Is there a split at the Fed? What message do they want to send from these? So this could potentially stop a stock rally if they say, okay, one of the things we have to consider here is that financial conditions have actually eased recently. This is not what the Fed wants to see just yet. So it'd be very interesting to see if they want to send a little message in there to suggest that the Fed is nowhere near pausing or pivoting. And, that could stop the stock market rally. So, tonight is relatively important, but we did have a fairly substantial press conference. So we need to bear that in mind, that most of what needs to be said has been said. Will we get anything new tonight? I don't know, but the market is nervous into this. Global preliminary PMI data started today. it kicked off in Australia. It wasn't good news from Australia. Both manufacturing and services missing. Have rate hikes created a recession? Again, we don't know yet, but they are doing some damage. Now, I think one thing that people need to understand is that, particularly with the Fed in the UK, we now got aggressive rate hikes plus QT. This is the opposite of QE. This is actually actively reducing their balance sheets. I'm not sure that the central banks can model the impact or the extent of the impact of that on the economy. And so they could be going too far with rates and QT together. We've got some time to wait before the ECB does QT. That's probably going to be first quarter next year. But central banks are beginning to take back the liquidity that drove stocks higher. So as that liquidity or drug is removed, if you like, then there are potential risks for stocks going forwards. So US preliminary Q3 GDP comes out on the 28th of November. The interesting thing with this is bad news good news for stocks? So get my point here. If bad news comes out and data's weak, does that mean the Fed can actually hike less because the economy is suffering more? So that could be good for stocks because the Fed isn't going to. But at the end of the day, is a recession good for stocks? Not really. So it's very, very difficult. We're at a real inflection point here. So PC inflation is obviously the key. It's one of the favorite data points for inflation for the Fed, particularly the core. So PC inflation comes out on the 1st of December. Is that going to confirm the dip down in inflation data that we saw? It's vitally important data. Keep an eye on that. This stuff needs to be on your screen. Put your economic calendar on your screen every day now, all the way into year end. Non-farm payrolls come out on the 2nd of December. I mean, what carnage could that cause in a rapidly depleting liquidity environment? So it's going to be interesting. This unemployment rate, could we start to top 4%? If so, the Fed is probably going to start looking to do less. They see a need to get unemployment towards 4.5%. A 4% print would make a difference. So again, bond yields down, dollar down, probably stocks up. We get CPI on the 13th of December, the last data input pre the next FOMC meeting. Highly, highly important data. Does it or will it suggest peak inflation is now confirmed? So if we get a second move down, our markets are going to start thinking we're trending down in inflation now. And the peak inflation story will be there. So other major central banks are already pulling back on aggressive hikes, or at least talking about them. 14th of December, will the Fed slow rate hikes? If so, 50 basis points. I think that's priced at the moment. Is 25 basis points a possibility? Well, the interesting thing here is that the data between now and then could actually suggest there is a possibility of that. So data is vitally important. You need this economic calendar on your screen every day and watch what's coming out. So this is really important, and not just for the Fed, not just for the dollar. The Bank of England and the ECB have similar issues. In the UK and EU, the lack of economic growth has given the BOE and the ECB a major headache to deal with. They've got to deal with inflation, but at the same time, there are substantial risks to growth, which could stall the economy, stall consumer spending, and see us move into deep recessions. So if you look on the right here, you can see the UK economy shrank between July and September. Not good news at all. And this is slightly backward-looking data. Slower growth in Europe, stronger inflation. Bottom chart. It's as clear as day. This is not something that is easy to deal with. Is there a danger of a policy mistake here? Yes, there is. Will they go too far? Will they not do enough? What do they focus more on, inflation or growth? At some point, that scenario is going to be tested, I think. So can they deliver on rate hikes if the economic data continues to show weakness? That is the question that everybody wants answered right now. And at the moment, we're not quite sure, which is why we're seeing this volatility. Certainly uncertainty has led fund managers to be underweight UK and European equities, but we are seeing a good rally in European equities considering everything they're facing going into winter. They've been performing pretty well, to be honest. But China reopening, is that going to happen? I'm not sure. It would be a plus for the German 40, definitely, but COVID cases are rising. And we're coming into winter. Why would they reopen just going into winter when COVID cases are going to be worse? I don't see it. So could this rally in European equities get challenged? Very much so. Is there a resolution in the war in Ukraine? I can't see it. The only way I can see that at the moment is that I do think Russia is losing that war to some degree, but I don't see him walking away unless there's a regime change there. I don't see it happening. So, you know, the sanctions remain and the supply issues remain. Brexit, Northern Ireland trade deal sounds like it's a real positive. Sterling's back above 120. This is a positive for the UK, but they're talking about it, but it's not resolved. So, you know, where does this end? It'll be very interesting. But if we look at the chart on the right here, the fund management service looking at regions at the moment, the most bearish at the moment is probably Eurozone and UK. So, and yet the stock 600 in Europe has actually done quite well, but the market is very bearish on these two. And that is probably because both are looking at potentially pretty severe recessions, and they're not good for stocks. So earnings and positioning, I just want to finish with, I mean, these are really important issues. Earnings and positionings do matter. Q3 earnings had been marked lower. So some of the expectations, some of the earnings beat, but they were from low expectations as well, because they'd all been marked lower. 70% of companies did beat expectations, but does that mean they're really healthy? Not necessarily, because it depends on where the expectations were set. So you can see the earnings scoreboard or scorecard on the right here. You know, they're not far off, but again, estimates are one thing. Real earnings and real margins are something else. So there were some nice exceptions in there. Companies like Target, the big retail, overstocked, too large inventories. They've got to sell the stuff. They have to sell it cheaper to get rid of it. Margins collapse. And there's margin issues for many companies, but also there are very large implications for companies that have survived on cheap borrowing. That cheap borrowing is over. So a lot of these, what we call zombie companies, are going to be stressed into all this. And some of the big tech names borrow cheaply and are having to actually spend an awful lot of their margins on debt financing because rates are rising. So can this positivity be extended into Q4? I'm not sure, because there is so many moving parts. So I think positioning is quite important. I think the market is a little more square on equities. I think the market has taken some of the dollar longs off as well. But recent Bank of America fund management survey, which I think is really valuable information, has suggested that positioning is underweight equities and overweight cash. As you can see on this chart on the right here, there is a lot of cash on the sidelines. What's it going to take to move that cash back into doing some work? And that means back into equities or whatever. But the big money managers are being forced back into some of these markets, because with benchmarking the way it is, they cannot afford to miss the equity rally when it comes. Is the low in place? We don't know, and we probably won't know for some time. Are there going to be times of stress? Yes, into year end, I think there's a very strong chance of it. We've got month end coming up in the next few days in November. Year end is going to be a big issue as well, when liquidity really does become a problem. So, you know, I just wonder if this cash can be put to work, or whether fund managers wait until maybe 2023. So it takes more than one. Bear market rallies can be forceful and still fail to prevail. Is this a bear market rally we're seeing right now? That is the question. Is the low in place? We don't know. There are risks out there. But if we look at some historical analysis here, it's very unusual to start a real bull market partway through a monetary tightening signal cycle, especially when it's coming from the Fed. So we need to be wary here of exactly what's going to happen. And I think, you know, bear market squeezes can be numerous. It's a lot of noise going on at the moment. I think a substantial structure of where the market's going to go for the next, say, 5 to 10% is very unclear. And there's so many reasons why that I think it's worth keeping your powder dry, or at least trading shorter term, trying to make some money out of short-term trading at the moment. But remember, these bear market squeezes happen. They're very common. Has the downtrend shifted back to up? Not yet on the charts, but there are some positive signs. But it depends what inflation does around the world, and it depends how central banks react to those.